Hooty hoo, all my stock market gamblers. Welcome today. I'm Tall Mike. So glad you're here. Well, it's Monday. I love Mondays because the market's back open. What's going on in the stock market today? Well, we're up 150 on the Dow, up about 40 on the Nasdaq. So we're having an up day. What's the stock market doing in general? Well, that's a good question, right? So we've been down 3 weeks. We came down 3 weeks in a row. And last week we had an up week, right? So 3 weeks down and an up week. And that's just from the July high. Now, I think that July high is going to hold. I think that's going to hold. And now we may get another up week this week. We may bounce up a little bit. This is the week right before Labor Day. Very common to push the market around, push it a little bit higher, maybe. A lot of people on vacation. I do think the selling will resume next week and we'll head lower. I still think we're in a bear market, if you will. I think the Moon Boys have this wrong. The Moon Boys think that this is a new bull market and we're going to the moon. I don't see it that way. Now, the HYG, which is the junk bonds jumped up today. That means that we're probably going to pull the market up a little bit higher with it before we resume the downward trend. Now, this is just my take. Your take may be completely different, but I do think this market is going to come back in. Once again, this is the week before Labor Day. Typically an up week, might get a slight up week this week, and the selling resumes next week. Just my take. All right, let's get over to the real estate market. Now, in the real estate market, it's always fascinating to me. Now, you could go out there and you could ask your local realtor, ask 5 local realtors. Take a poll. Ask them if it's a good time to buy. They'll tell you, of course, it's a great time to buy. Now, I'm a real estate broker. Why do I say it's a good time to wait? I think if you wait, you're going to save 40%. That's right, 40%. I think the market still has 40% downside to go from here. Now, we're down slightly, about 5, maybe 10% off of the high. The high where Billy Bob sold that and he got out. Now, I know your area, it just keeps going up, and I get that, but most areas have come off the high. Okay, so the market has come off the high, and I think we have 40% to the downside to go. But go ask any real estate agent. Let's take Barbara Cochran, for example. She's telling you that you have to get out there and buy right now. Why? Because she says that rates are going to come in. Well, she doesn't know where the rates are going, but she says if the rates come in, the houses are going to spike up another 10, 20%. Now, do I believe that? No, it would be the first time in history that the houses spike up when the Fed pivots. Usually the Fed pivots for a reason, and that reason is because there's a problem, and there's a problem like a recession, and that makes houses go down. So when the Fed pivots, I don't expect houses to shoot up. Now, I believe the Fed is in what I would call a checkmate situation. Okay, so if the Fed raises rates, right, they're going to crush the banking system, crush the pension funds, crush the real estate market. So if they raise rates, they're going to crush all of that. Okay, but if they lower rates, they're going to see that inflation number start to run back 7, 8, 9, 10% and higher. So they're kind of stuck between the rock and the hard place. And it's going to be fascinating to watch them get out of this mess. Personally, I don't think there's really a way out without a lot of massive pain. Now, that's just my take. Now, one article I read over the weekend are why are mortgage rates so high? Why are they so high? Mortgage rates are up around 7.5% for the 30-year mortgage. Now, Lawrence Yun, now he once again is the chief economist for the National Association of Realtors, and he can't really, he's puzzled because you see, he says that normally the mortgage rates are about 2% higher than the 10-year rate. 10-year rate running about 4.25. He says it should be at 6.25, but we're closer to 7.5. And I think he has that number a little bit off. The normal mortgage rate is about 1.5% higher than the 10-year yield. 10-year yield is 4.25%. 1.5 would put us at 5.75%. But Lawrence, he's a little bit confused. It's shocking to me when when the big chief is puzzled. He should know these things. So why are rates at 7.5 when history would tell you they should be a bit more closer to 6? The reason is because there's a lot of risk in the marketplace. If you go out and buy a home right now, there's a lot of risk that you're going to lose all your equity. That your equity that you put down, the money you put down is going to get wiped out if you go buy right now. Now, I'm not going to stop you from buying right now. A lot of people have their own personal reasons as to why they want to go out and buy a home. And you can go out and buy a home. There's lots of homes for sale. People say there's no inventory. We have almost 4 months of inventory on the marketplace right now. Now, I agree 6 months is more normal, but we're getting up towards 4 months of inventory right now. So if you want to go buy a home, you can. The problem is these homes are not affordable. No one can afford them. And if you can afford them, if you're in your right mind, you'd be going, well, they're way overpriced. They're a bubble. We're in a bubble, and right now you could go out and buy a home that you can't afford, and then you could pray that the Fed pivots and that the rates come down so that that would mean you could refinance and then afford the home. But why would you want to buy a home that you can't afford? Nobody knows what direction the mortgage rate's going in. Now, if you ask Lawrence Yun, the big chief himself, he'll tell you that mortgage rates are going to go back to 6%. If you ask the Mortgage Bankers Association, they'll tell you they're going to drop down to 5%. Now, if you ask Tall Mike, I got a little bit of a different opinion. I think you're going to see 9% for good credit, 10% for bad credit. I think we're going to see 10% mortgage rates. Now, this is just my take. Your take can be more in line with Lawrence Yun. He says they're going to come down. Nobody knows where they're going, right? Nobody knows for sure. Inflation takes off. Maybe the Fed has to keep raising. We don't know. But here's what I do know. Here's what I do know. A lot of the sellers right now, they're starting to panic a little bit because the days on market are taking a little bit longer. Used to be I could put a house on my street for sale and it would sell within 2 to 3 days, right? Now it's taking 2 to 3 weeks. In some areas it's taking 2 to 3 months. The days on market is getting longer. What happens when the days on market gets longer? People reduce the rate because they panic, right? Price reduction, price reduction, price reduction. Now, we're not really allowed to say price reduction as a real estate broker. We're allowed to say price improvement, price improvement, price improvement. So there's going to be a lot of price improvements. Now, I think that price improvement is going to be about 30 to 40%. Now, what's going to happen when it drops that much? Well, a lot of the equity people have right now, there's a lot of equity envy. People like to talk about how much they've made on their house just in the last couple of years. They gone up 20, 30, 40% in a lot of areas over the pandemic. So they like to talk about all the equity they have. Well, if they sell now, if they sold when Billy Bob sold, they would get all their equity out, right? But not everybody gets all the equity out. The first person gets all the equity out, and that's Billy Bob, and he's already left partying down in Mexico. He's very happy with his equity, right? But the next person, he can get a price close to what Billy Bob got and get most of his equity. But as things start to drop, people will not be able to get their equity out. The equity will go away. It'll be wiped out. There'll be no more equity envy. Now, maybe there'll still be rate envy, right? Because you're locked in. You're locked in at 2.8%. That's not going to change, right? That's not going to change, but your house is going to be dropping in value. Now, this is a big problem. We have a lot of big problems going on right now. Now, we have a banking crisis that people are just trying to sweep under the rug, really. They don't want to talk about this crisis. And believe me, it is a crisis, and it's much worse than they're telling you now. The banking system, now they've been downgraded, right? Well, Fitch, one of the rating agencies, they downgraded the whole United States, right? S&P already downgraded the United States, so two have downgraded the United States, right? Now, Moody's came out and started to downgrade the banks. And now who's starting to pile on? Well, Fitch is starting to pile on, S&P is starting to pile on, so they're all starting to downgrade the banks. Now, let me explain about these rating agencies. A lot of people don't understand them. Well, back in the subprime crisis, people would bundle together mortgages, right? They were mortgage-backed securities, and they'd have to get these rated so they could sell them to Wall Street. Well, how did they get them rated? Well, they'd send them to the rating agencies. They'd send them to Fitch, S&P, and Moody's, all right? And they would rate them AAA. Now, who was paying them to rate them AAA? Well, the person that was submitting these mortgage-backed securities for rating. They were paying them money, say, hey, give me a AAA rating. Here's the money. And they would just rubber stamp it, AAA, 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 right? Well, okay, well, that's kind of a big conflict of interest. But if they didn't give them AAA, they would go to one of the other rating agencies and take their business away. So the rating agencies have this conflict of interest. They'd have to rate them AAA so that they didn't lose the business. Now, okay, let's think about these rating agencies today. Well, these are all private companies, but who owns these companies? These companies have the investors of the banking system, of the banks that they're rating invest in these companies. They're the investors in these companies. So these companies that are doing the ratings on the banking system have skin in the game to rate the banks high. So you would think they would give them the AAA ratings, but they're not. They're starting to downgrade them, and they're kind of like hurting the people that own them. Okay, so this is a serious problem. They're not downgrading them much, but if they're downgrading them just a little, you know that it's much worse than that because they're owned by the banking system. There is huge conflict of interest in this ratings game. So the banking system itself could have a major credit crunch. Now, what happens when there's a major credit crunch? Well, people cannot get loans. They can't get loans to buy cars. They can't get loans to buy houses. Credit starts to tighten up. So what does that do to the housing market? Starts to send the housing market lower. Even if you have an 800 credit score, you might not be able to get a loan. It becomes an all-cash market. It locks up. Now, there are still cash buyers out there. About 20%, maybe 25% have money to go buy all cash. But these people are the smart ones because they're sitting on cash, and they didn't get all that cash by not being smart. You see, the people that aren't smart already blew their cash on fancy cars, lifestyle, vacations. But the people that have been saving and have that all cash, well, they're the smart ones. And they know that they're going to get a bargain on these houses. There's going to be some bargains out there. These houses are starting to circle the drain. They're kind of in a downward spiral. A lot of people don't believe that. In your area, they only go up. Look, we have started to turn down. We had the hot selling season, which is the spring months, right? And we had 4 months in a row, I think, of straight upward prices. But now those prices have started to come down again. Redfin came out with the numbers. July numbers were down. August numbers will be down. We're just in August. The housing market is locked up again. And if you get the banking system to lock up with the housing market, it's a big, big, big problem. I mean, you're not going to be able to sell at any price. But it's good. You're locked in at 2.8%. But the houses that are sold on the margin, someone's going to have to sell. There's going to be a divorce. There's going to be a job transfer. Someone's going to die, right? I mean, I know in your area, there's no death, there's no divorces, and no one ever loses a job. So your area is going to be fine, but most areas, there's going to be what's known as forced selling. These people have to sell. They don't want to sell, they have to sell. And when the people that have to sell, they have to sell at any price, and that price is going to be a lot lower. That is the new comp for the area. When the people that start to see the prices starting to drop, the ones that don't have to sell are going to become wanting to sell. They're going to want to get some of their equity out before the equity is completely wiped out. So they will be putting their house onto the marketplace while they still have some of that equity left that they're bragging about because they bought that house for $700,000 and it's now worth $1.2 million too. But when it comes back to only $900,000, they're going to try to get out with a couple $100,000 of equity. But after selling costs, they might be lucky to break even because once the death spiral starts, it continues in the motion direction that the downward motion is, right? Well, it's like velocity. Once something starts going one way, it's got to hit something to come back the other way. Well, what we've hit in the real estate markets is 7.5% mortgage rates, and that's starting to push the houses down. Now, you can still get out at a price close to Billy Bob. I'm not telling anyone to go out and sell their house. That's not what I'm saying. Look, I have a principal residence, right? I love my house. I'm keeping it. I just know that my equity is going to get chopped in half. Okay, that's just what's going to happen. It's going to come down. Prices are going to come down, and I'm okay with that. It's going to take a long time for them to rebound back to the price Billy Bob got at. And people think, oh, they'll come down and bounce right back up. I don't think that's going to happen this time. They're going to try to make that happen. They're going to print 10 trillion, 20 trillion, 30 trillion dollars trying to blow up the bubble bigger. But that's how much they printed last time. They didn't realize since 2008, we printed $30 trillion already. So they're going to have to do a number a lot larger than that. Printing 30 trillion now will just make the problem worse. It'll be like pushing on a string. Won't get the prices going back up. So when we do come down, I think we're going to stay there. But they're going to try to print 40, 50, 60 trillion dollars to blow this thing up. I really don't think it's going to work, but I do think they're going to try. What's that going to do? It's going to make problems a lot worse. It's going to make the purchasing power of the dollar start to shrink. And this is going to be a big problem for a lot of people. A lot of people, they got their money tied up in the stock market. They got it tied up in their house. Their equity goes away. Their stocks get chopped in half. I don't mean to be so negative just starting out the week. Sometimes I get a little bit carried away on a Monday. Anyways, if you like this stuff, give me the thumbs up. Why not? I'm Tall Mike. Get out there, everybody. We got a lot of stuff going on this week. Punch that subscribe button. I want to talk to you again later in the week. Bye-bye now.